From the morning reading, macro hedge funds have greatly pulled back on their exposure to the stock market. Looking at a popular hedge fund index and comparing it to the returns in the S&P 500, it's clear that funds have pulled back greatly from where they were a couple of months ago and are showing the least exposure to the market in 2 years, which has led to mostly positive returns in the months ahead. The non-farm payroll report is today in about 45 minutes. It's one of the big four reports. The days have had a mixed performance, but trend was important. When the S&P was trading above its 200-day average, payroll days were positive 59% of the time since 2000 and averaged a return of plus 0.1%. When the S&P was below its 200-day average, like now, payroll days were up only 42% of the time, averaging a minus 0.3%. When the S&P was above both its 50-day and 200-day averages, the returns improved to plus 0.3 and a 66% win rate. When it was below both averages, like now, then it was up only 32% of the time, averaging a minus 0.6%. So the negative trend seems to be a headwind for the reaction to tomorrow's report. The suggestion for more upside refers to the short term, but not the intermediate to long terms. We are still in a bear market, a genuine bear market, so we shouldn't expect bullish results. However, even in a bear market, there are rallies, and the important thing to remember is that these rallies are there to release some pressure, and only the last one will mean the end of the bear market. There will be plenty of signs in the indicators that reflect that the bear market is finishing. Unfortunately, the signs aren't there yet. The monthly chart in the SPY is telling. It implies the bear market is on and is likely here to stay longer than the bulls would like. Cycles rarely start and end right on time, but the chart illustrates that it could take weeks to months before the next trough appears. Not even taking the cycles out of the picture can make a bullish chart bias. The 6-month EMA, exponential moving average, crossed below the 10-month EMA at the end of September. It's very important to have this larger and longer term bearish bias in mind when we consider getting bullish results. The indicators do suggest more upside, but being short term, I'd be aware of joining in or at least be prepared for a bull trap. A move to the top of the symmetrical triangle around 196 on the SPY chart is the most optimistic I am regarding the short-term bear market rally. As price continues to bleed upward, an increasing number of bears figure out that there is no more downside available, and a stampede to higher prices will ensue. That second part there, that's referring to an opinion from another author, which was setting up the case that the bulls could take over and a rally could go further than what many might suggest. So you had kind of mixed in there, especially towards the end of that reading, two different suggestions. And one is that we should keep in context the larger terms cycles, the larger term trends, and these all point to, with lower lows and lower highs and so forth, a generally bearish set of indications. But on the short term, you can have within these bear markets some very explosive rallies, and sometimes those rallies can go farther than people might expect in a bull or bear market, in this case a bear market. And often some of the biggest bullish days, some of the biggest rallies, and indeed we saw this here, can occur in bear market trends as the shorts get kind of run over and they start to cascade out. And the same thing happens on the downside, of course, when people start to get run and you get a cascading effect as price just seems to just fall out of bed. So that can happen in the reverse. So just be careful that when you see a rally that if you want to start entering positions, that you start doing it with relatively small until you get increasing levels of confirmation. Because as earlier in the reading mentioned, there's only one rally that counts, and that's the one that changes the trend from bear to bull. That's March 9th of 2009. But prior to that March 9th, there were many false rallies that didn't lead anywhere and just simply trapped the bulls as the bears reloaded and then took the market back down again. So several interesting things going on here. And if your primary purpose is to control risk to your portfolio, then it's very important that you keep that in mind. And that's why it's a very good idea that you scale into positions and nibble at the beginning when you think that there's a trend or a bottom, and then only add significant size when that trend starts to confirm and gain momentum, real momentum, and not these kinds of false. And you take a look, here's the FOMC day. We had a false breakout, immediately failed. We've had a reversal pattern here, which indeed led to a bounce. But if you look at this, this move here, how many points was that from here to here? And then if you do a fib extension, we've only made it back, a third of the way, and yet here we are with another reversal pattern. Now, this reversal pattern in this case was leading into an not an FOMC, a monthly unemployment report, and which they now call officially the employment situation. Very politically correct there. But that monthly report is one of the big four reports, and that could have a big impact on today's trading action. Now, one of the premises you have to keep in mind is that you could have an immediate thrust up just to be met by selling and then end up the day down. So be very careful that you think you know what the move is and what the market thinks of the report by the initial thrust, especially through the beginning of the cash market. There's the big picture here is bearish, and until proven otherwise, you should be suspect, but also recognize at the same time that bullish rallies can occur, and eventually we're going to get a bullish rally that's going to actually count and hold and be the start of something big. So very, very nimble trading when you're in these kinds of situations. Not the easiest of times to be able to trade. There's not a lot of pot odds on either side right now, given that we're kind of in the middle of this pattern. There's the SPX. Here's the Russell. Of course, the Russell's been even weaker, but also had something of a hammer pattern. NASDAQ yesterday, doji, or excuse me, a hammer pattern. And then a doji on the Dow. So you had hammers and dojis across the four indices, all looking at the very best indecisive, at the worst as a reversal pattern, needing confirmation today. So we'll see where that goes. But for the bulls to take this lower pattern, and it was showed up best I think on the SPX, to take this lower pattern and have a reversal, but then to run out of steam so quickly and then set up for another reversal pattern going to the downside after only a couple trading sessions isn't very, very inspiring, I guess would be the right word. So something to kind of keep in mind. Now, of course, new information comes into the market with the employment situation report today, and if that really impresses or uninspires, that could absolutely give energy to wherever the market was thinking it wanted to go anyhow. So let's go ahead and dive into our regular reports. The broad market, relatively quiet. it's at the time of this cut, it was up about 6 points on the S&P futures, or about 1/3%. It's actually up just a little bit more than that right now. Russell up about 1/5%, Nasdaq about 0.5%, Dow about 1/3%. Crude oil up nearly 1%. Had huge move yesterday, so it'll be interesting to see how that digests. We have the euro down marginally, bonds essentially scratch, and gold down about 0.2%. In overseas markets, they're all up. China up about 0.5%, Hong Kong up over 3%. Japan essentially scratched to slightly positive. Germany up about 1.5%. United Kingdom up well over 1.5%. In terms of macroeconomic reports for today, of course, the big one we talked about, the non-farm employment change and the rate. There's also, and it doesn't show it on here, but I know that there's a whole slew of various speakers that will be talking about various things with the global and U.S. market. So if you see, all of a sudden something seemingly come out of nowhere in your intraday price action, you may be getting an influence for some of those speakers that are out there on the tour today. In terms of special volatility conditions, skew, nothing here of note. Below 125. Short-term VIX has been dropping. You remember this was up over 30 just a few days ago. Down below 22 at this point. Trend, nothing really to get excited about there. So nothing really in front of the unemployment report to tell us that there's particular probability or risk levels in the market. IV percentiles all relatively benign, kind of middle of the road, 40, 40, 42, 46. No standard deviation moves were put in yesterday. And for that matter, if you take a look now in the past 2 weeks, we normally expect on the S&P about 4 days in which a standard deviation move was put in. Perhaps a tad heavy in that 2 of those days were 2 standard deviation moves, but by and large, there's an awful lot setting up just in terms of, potential squeeze, as a matter of fact. And we can look at this a couple different ways. One here is the VIX, and you notice, the VIX is just about to go into a daily squeeze, and that could mean that we stay in range action for a while. And then here's the SPX, and had a squeeze about a week ago, and then exited out to the downside. So that would seem to say that we're going to have more downside action, but certainly didn't explode out, and certainly didn't explode out like it did back here. And look at this. See, this was a daily squeeze, and then it exploded to the downside out of that squeeze. Well, now it went back into another squeeze, and then indeed did move down and came down to near the prior swing low, but the bulls were able to hold on to that level. So you have to say that the bulls still have some power here. This move could have easily rocketed right through this prior swing low, and especially driven by the energy of the squeeze being set up to the downside in the direction of the primary bias of the market trend. So that kind of whittled away. So enough time on the charts today. Let's go ahead and bounce over to our daily report. Still market and correction, still accumulation distribution at a D-, NASDAQ and E. GMI index still a 0 out of 6. Primary market condition remains strong, bear. Decision point scoreboards, a sea of red arrows with just this one lone up arrow on Dow. And remember, that author talked about that one as being a potential bull trap. Intermediate term market posture still remains very bearish, and indeed you see S&P now at 17.6, NASDAQ 38.8 and bearish, and then the Russell 10.4, very bearish. You do have an outlier here. The Dow did pop and turn up and is now 37.2, so bullish, and probably should more properly call that weekly bullish. at this point. Overall hedge warning status remains a threshold level 3. These are very elevated levels of risk. There is the indications that the various risk indicators are telling us that there is the potential for significant down moves to occur at any time. It is not a prediction of that move or a prediction of how far that move would go, but it is just simply a recognition that the conditions are available right now that we could have a significant move down. Volatility-based metrics, market and decline warning has fired. A number of things did come off. That spike went away. The volatility warning went away. The skew has ebbed. So some things have improved. I found this kind of interesting yesterday, though. While we had this hammer pattern and stuff like that, we actually had significantly more new lows than new highs. And then the intermarket risk aversion indicators all are still risk off. In terms of special opinions, it's still very, very negative about initiating new positions, whether it's option income strategies, cover calls, or put selling. For novice traders, really not a good environment to be initiating any of those strategies at this point. It's mostly about controlling your risk and keeping your powder dry for better market conditions. In terms of sector market postures, you see the two consumer discretionary and staples sectors did show some improvements. We've been seeing improvement from utilities. That still is holding up, though everything else is still down in all time frames. Percent change yesterday, materials, healthcare, consumer discretionary were the best performers. Utilities taking the big hit. And we've been talking about being careful with utilities as we work against both this ebb and flow of the bulls needing defensive places to go, and yet at the same time the concern about the unwinding of the interest rates in the face of the Fed. This has really been a tough place to win, though it has been generally one of the more positive places to be. So not saying that it's not a good place to be and to put some of your capital, but at the same time, it could still be negative. And you see the year-to-date's actually down almost double digits. So kind of a squirrely place to be, perhaps. So if you like what you've been getting here, certainly retweeting us to your Twitter followers, to your StockTwit followers, Scootify, also liking us on YouTube. All those things are very much appreciated. Email support can go to support@falconglobaltraders.com. Also a reminder, we've been talking about this course that is available in collaboration with the Chicago Northwest Burb Trading Club. It's a 40-hour course, self-directed, active money management, 10-week course, 4 hours each session, plus some bonus sessions. It is the 9th time that has been taught by Nick Fosco, so he's got this well dialed in for you. And you see the purpose here. It starts on Saturday, October the 10th, so a little over a week from now, and it will run from 9 to 1 each day. It will be taught live in person in the Chicago suburb of Schaumburg. But for those who are not local, it'll be simulcast to the web, and certainly you can participate in every way. For more details, find the course description and get more details about that, as well as to sign up. You see the website that you would want to go to. Okay? Disclaimers as always. Hit the pause button if you need more time to review this, and we'll see you back here Monday morning for the market preview from Falcon Global Traders. Good trading.